So we said that when we acquire the acquiree, so we have to measure the net assets of the acquiree at the day of acquisition at fair value. So we understand that once we have to measure them at fair value, so the fair value may be different from the book value. For what we have studied in Intermediate Accounting 2, we understand that when there is a revaluation, there may be a deferred tax implication. Therefore, actually, for this recognition of net assets of the acquiree at fair value, there may be a deferred tax implication. So from what we have studied so far, if this is an asset, so if the fair value is higher than the book value, there may be a deferred tax liability. The other way around, if the fair value is lower than the book value of the identifiable asset, there may be a deferred tax asset. Strictly speaking, we cannot offset assets with liability. So therefore, if we find that the assets fair value go down, deferred tax asset. When we find that the fair value of the assets go up, deferred tax liability, we cannot offset this deferred tax asset and liability unless the question tells you that you can. One exception is for the goodwill. There will not be any deferred tax liability to be recognized on goodwill. Goodwill, as I've said before, is a balancing figure. It's something I don't know. There will not be any deferred tax implication because this is not a temporary difference for goodwill. So therefore, we can measure goodwill. We got a good definition for goodwill under the Hong Kong Financial Reporting number 3. So goodwill is defined as the future economic benefits arising from assets that is not capable of being individually identified and which is not able to be separately recognized. I said that this is a good definition because this confirms the fact that goodwill is actually something I don't know. Because goodwill is something that I cannot identify, goodwill is something that I cannot recognize. If I cannot recognize you, simply means I don't know you, right? So that's why goodwill is something that I cannot identify. Goodwill is something that I cannot separately recognize. So that's why Hong Kong AS 38 intangible assets do not govern goodwill, because Hong Kong AS 38 intangible assets will govern only identifiable assets without physical substance. So goodwill is not identifiable, so goodwill is not under Hong Kong AS 38. In that sense, goodwill arises only because of business combination. Goodwill is supported of Financial Reporting Standard number 3. If there's no business combination, there should not be any goodwill. Goodwill should be recognized as an asset, and goodwill should be initially recognized at cost. This is how we calculate goodwill. So goodwill will be calculated as the aggregate of these 3 items. The 3 items are fair value of consideration transfer, the amount of non-controlling interest, as well as the fair value of the acquirer's previously held interest. So if you have got some shares before, some investment in this acquiree before, it should be measured at fair value at the day of acquisition. So this is 100% of the investment value, right? 100% of the shareholders' value minus 100% of the net asset. So what we pay minus what we get is goodwill. So we understand that consideration and the previously held interest, previously held investments must be measured at fair value. But for the non-controlling interest, accounting standards allow us to have a choice. You can measure the non-controlling interest at fair value. We call this full goodwill method. Or you can measure the non-controlling interest as a proportion of the identifiable net asset. We call it this partial goodwill method. Accounting standards do not have the name of the full goodwill method and the partial goodwill method. This is just a name given by the textbook. Accounting standard only tell you that you can measure non-controlling interest at fair value, or you can measure non-controlling interest as a proportion of the identifiable net asset. Take an example to illustrate. In this case, we have acquired subsidiary on 1st of January 2008. The fair value of the net asset, 2,170. So on the day of acquisition, we must measure everything at fair value. So I acquired 70% of the shares. So therefore, there should be a 30% non-controlling interest. For this question, the fair value of non-controlling interest is given 919. So that's why assuming that because we have got the fair value of non-controlling interest, basically we can measure non-controlling interest at fair value. Therefore, full goodwill method will apply. So how much I pay? I pay 2,145 for 70%. This is just for 70. So therefore, there will be a 30% contributed by non-controlling interest. If you have got a previously held interest, there should be 3 items here. But now only 2 items because 70% is paid now and 30% is from the non-controlling interest. Altogether, the cost of business combination 3,064. This is what we pay. What we pay will be compared with what we get. We get all the assets and liability of the subsidiary, 2,170. So what we pay minus what we get is goodwill. So if we measure non-controlling interest at full goodwill method at the fair value, in your consolidated financial statements, goodwill will be 894. However, accounting standards allow us to measure non-controlling interest at a proportion of the fair value of the net asset. Fair value of the net asset is 2,170. NCI is 30%, so proportion of the fair value of the net asset, then NCI will be measured in your consolidated financial statements at 651. So I pay 2,145 for 70%. NCI contributed 651 as a proportion of the fair value of the net asset. So what we pay, 2,796. What we get, 2,170. So goodwill will be stated in your consolidated financial statement as 626 if we are using a partial goodwill method. That means if NCI is measured as a proportion of the fair value of the net asset. So in your consolidated financial statement, it will be 626. Both are allowed. In your consolidated financial statements, in your disclosure note, you have to disclose how you measure the NCI, non-controlling interest. If you tell us that your NCI should be measured at fair value, then I know that you are using full goodwill method, so I expect that it should be 894. If you say that non-controlling interest is measured as a proportion of the fair value of the net asset, then I expect that only partial goodwill. What actually is partial goodwill? Partial goodwill means you measure only goodwill for the parent. We can verify. Parent pay 2,145. Parent get 70% of the net asset. So what parent pay minus what parent get is 626. So sometimes we can simply calculate this partial goodwill. That means the parent's goodwill using this what parent pay minus what parent get. It must be the same. The difference between the partial goodwill method and the full goodwill method is the goodwill for NCI. We can also verify NCI pay 919 in fair value. NCI get 30% of the net asset. So what NCI pay minus what NCI get is the goodwill for NCI. So goodwill for NCI plus parent's goodwill must be the full goodwill. Full goodwill simply means the total goodwill. So 894 include the goodwill for parent and goodwill for NCI. Once we have calculated the goodwill, goodwill is just like any other asset. Goodwill is subject to impairment review. So goodwill is a little bit special, so that's why we must test goodwill for impairment every year at least, or more frequently if you find any indications of impairment. So impairment simply means you try to compare the recoverable amount with the carrying amount. If the recoverable amount is higher than the carrying amount, no problem. no impairment. If the recoverable amount is lower than the carrying amount, you have got an impairment. In normal case, no problem, we just measure the recoverable amount with the carrying amount. But because we can use the partial goodwill method, therefore if we are using the partial goodwill method, then NCI is measured only at the proportion of the fair value of the net asset. So in your consolidated financial statements, you did not include the goodwill for NCI. Therefore, the carrying amount in your consolidated financial statements may be understated. Therefore, we must gross up to the full goodwill, to the estimated full goodwill. So that's why you will not compare the recoverable amount with an understated carrying amount. Take an example. In this case, if we are using the full goodwill method, then of course no problem. We compare the recoverable amount 180 with the carrying amount, right? So therefore, if the carrying amount is higher than the recoverable amount, there will be an impairment. Whenever there's an impairment, we will allocate to goodwill first, right? Then we will allocate to other assets on a pro rata basis, because this is an impairment for a cash generating unit, so it must be allocated to goodwill first. So therefore, in this case, because the impairment is 80, so you will debit impairment loss 80 and you will credit goodwill 80. So in your consolidated financial statement, goodwill will be reduced by 80, and therefore the carrying amount will become 180. So if the impairment loss is more than the goodwill, maximum amount that you can credit away from the goodwill is only 100. So that's why you credit goodwill 100, you debit impairment loss 130. Then the other credit, you may have to credit to other assets on a pro rata basis. We don't have information here, but it may be the property, plant, equipment, fixture, furniture, motor vehicle, etc. on a pro rata basis. This is a full goodwill. If this is a partial goodwill method, then problem. Because in your consolidated financial statements, this goodwill of 90 is only the goodwill for parent, right? Only the goodwill for parent, because we are using partial goodwill method. So the partial goodwill means this is only the goodwill for parent. Therefore, the carrying amount, if you simply add together 90 and 140, we underestimated the carrying amount. So therefore, before we compare the recoverable amount with the carrying amount, we must estimate the notional goodwill for NCI. If goodwill for parent is 90, goodwill for NCI on a proportionate basis must be 30, because NCI is 25%. So if 75% is 90, 1/3, 25% for NCI must be 30. This is just a proportional. So we estimate the notional total goodwill, including goodwill for parent and goodwill for NCI. So we compare this notional goodwill with other assets. And this is the total carrying amount. And we compare it with the recoverable amount. When we compare this carrying amount with the recoverable amount, we know that there is an impairment loss. So we know that impairment loss will be 80. But we cannot debit the impairment loss 80, because basically this impairment includes the impairment for the goodwill for NCI that we have not recognized in the consolidated financial statement. So instead of debiting everything, you can only account for 75% of the impairment, because you did not recognize 25% for the non-controlling interest. So that's why out of this 80 that you want to credit goodwill, you can only credit goodwill 75% of the 80. So that's why we credit goodwill 60 and we debit impairment loss 60. This is a tricky point, because you did not recognize the goodwill for NCI in your consolidated financial statements. You cannot credit away the goodwill for NCI in your accounting entry. So only the parent's portion, that means the 75%, should be credited away. So goodwill is the balancing figure when we pay more than what we get. So what we pay is more than what we get. We say this is goodwill. The other way around, if the aggregate of these three items, that means what we pay is less than what we get. If I pay 100 but I get 120 net assets of the acquiree, we don't have a credit for goodwill because goodwill is an asset. Goodwill must be debit. So that's why we don't credit goodwill. Instead, this is a credit. So we credit to gain on bargain purchase. Gain on bargain purchase is a profit and loss item. This is a gain, right? So before we really recognize the gain from the bargain purchase, we have to measure, we have to check all the figures because gain on bargain purchase is not frequent. Usually we cannot buy something so cheap, right? So that's why we have to check all the figures. If really what we pay is less than what we get, we recognize it as a gain, profit and loss.